At this point, the level of interest rates is irrelevant to keeping the system from crumbling. They need to print more money, and they will be printing more money.
The land of Arcadia.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And as we are ending 2019, great to have my good friend Dave Kranzler back on the show. I don't know, is this going to be our last appearance of the year, Dave?
You tell me. I like coming on your show anytime you want to do a show. I mean, I would do it once a week if you wanted to.
Well, maybe we'll do that. I did get to see Dave this morning at a breakfast for EMX hosted by Trevor Hall of the Mining Stock Journal. So
Mining
nice.
Stock Daily, and
Mining Stock Daily. So it's nice to see them. Nice to see you this morning. Nice to have you back on the show, because as we round up the year, curious what you think of all that's happened, and especially in the gold market, what to watch out for in 2020.
Well, I mean, Jake Powell was on TV this afternoon telling me exactly what I should think, right? Yep. The economy's in a good spot. Monetary policy's in a good spot. There's very low inflation. Everything's great. I mean, what else is there more to think about?
Did he comment on the repos, or whatever you call the latest intervention they're doing, where they keep saying everything's great, but the banking system is apparently on pins and needles? Was there any mention of that today?
Someone asked him a question, and I mean, he's just spouting the party line. Temporary liquidity problems, and there's regulatory issues that are, causing liquidity stress on the banks, which it's nonsense. Those regulatory provisions were put in place almost 9 years ago. Right. So why all of a sudden is it becoming an issue now? I mean, well, first of all, Jay Powell's not even a trained economist, and I don't know if that matters or not, but he's clearly very unsophisticated when it comes to finance, or he thinks that his audience is unsophisticated. So, I mean, the reality is that there's a liquidity problem in the banking system because you've had an unprecedented level of speculation in risky assets, especially debt assets, CLOs, subprime loans, leveraged bank loans, and it's been fueled by multiple years of money printing and zero interest rate policies from the central banks. And on top of that, you've had an unprecedented amount of leverage put on at an unprecedented rate over the last 5 to 8 years. And that's fueled this massive bubble. Well, the central banks slowed down their money printing. The Fed actually tried to take a little bit of the money back out of the system. The debt creation has slowed down because we're running up against a wall in the ability of the global system to support more debt. And what it's caused a lot of, especially at the margin, on the edge, the triple C rated and lower investment grade rated debt securities are losing value, and a lot of them are losing value quickly. I mean, look at WeWorks. That's a good example. And what happens is you need to have capital to plug those holes. You've got a lot of subprime debt out there that they're not being serviced by the people who have taken those loans out. So there's cash flow shortages, and that's the holes that are being plugged with the repo. And, I get kind of tired of hearing this nonsense about, oh, well, corporations need liquidity to pay quarter end taxes and things like that. All of a sudden this crops up like the boogeyman in the third quarter of 2019. Give me a break.
Yeah, and it's interesting because it looks like one of the quotes from the Fed's meeting today was that they plan to pause for the foreseeable future, which, curious your take, are we at a point of no return where if they actually pause, then maybe not a tightening, but that's going to be some pressure on the stock market? They're almost forced into printing more eventually, which perhaps will drive the gold market higher?
No, at this point, the level of interest rates is irrelevant to keeping the system from crumbling. They need to print more money, and they will be printing more money. I mean, the last, the last 3 months, since mid-September, the Fed has printed money at the fastest rate in its history, a faster rate than it was printing money in 2010. So, if you look, there's guys out there who put together correlation charts that show the correlation between the daily repos and the stock market. And on days when the repo is less than the day before, the stock market goes down. If it's held the same or goes up, the stock market goes up. And you're at the point now we're taking interest rates from, what are we, 1.5 to 1.75 is the target range or whatever. Taking it down to zero is not going to have an effect on the stock market. And the Fed has to save some bullets in its chamber for down the road. Now, what I will say is that if anyone actually believes that they'll hold firm on interest rates until 2021, I've got a bridge that spans Queens and Manhattan Island, that I'd like to sell them, because we're at this point, we're at a point in time where we should still be in an interest rate hiking cycle, not an interest rate reduction cycle. And we should also still be in a quantitative tightening cycle where they're trying to pull liquidity out of the system. But instead, they're putting liquidity into the system at the fastest rate in history. So whatever Powell says, if you believe him, God help you, because you probably don't have two brain cells to rub together, or you're tragically naive. And I most of the time I have his conferences on mute. I don't even pay attention because it's a waste of time to listen to what he says. It's irrelevant.
Well, maybe I can get your nomination for one of the press badges for the Federal Reserve.
I wouldn't be allowed in that room, let alone allowed to ask a question. Those questions are highly screened.
Well, my backup plan, I'm going to invite Ben Bernanke on the show, and maybe he can explain when the virtuous circle that he wrote about in 2010 finally kicks in. But Dave, obviously the other metal, silver, curious where you see things with silver around $17 today. Obviously a lot of short paper out there, with all the factors you just mentioned, more QE money printing on the way. What do you see happening in the silver market over the next year?
Well, I see a lot of buying and selling.
Right. Good. That's why we bring on the in-depth analysis. Are they going to be buying and selling paper or physical, though, perhaps, is a good question.
Well, I mean, it is a really good question. Physical buying is driven by, jewelry consumption and industrial manufacturing type outputs, and technologies and manufacturing processes that use silver. I'd say that that source of demand is going to decline as the global economy slips deeper into a recession. I mean, even in the US, the manufacturing economy is in a recession. However, I think the case can be made, contrary to some of the commentary that's been put out there about the true supply of silver above ground, that essentially I think India and China would probably buy all the silver that's produced every year if they could get their hands on it.
Right.
So I think what we're going to see is similar to what we saw in 2008, starting in 2008, and that is because obviously for the last 5 or 6 years, retail buying of silver has been depressed because most retail investors they follow momentum. So and in terms of the two monetary metals, gold and silver, the smaller investors who are buying silver for investment purposes and for wealth protection purposes, they prefer silver over gold because you can buy a lot more a lot higher quantity for your money, right? And I mean, it's actually easier to sell to unload silver coins than it is gold coins. I think what we're going to see is, to the extent that retail investors have some disposable cash, I think you're going to see it'll probably happen gradually. I think it has been happening gradually over the last several months, although, I stopped following the mint coin sale volume a long time ago. But you're going to start seeing a lot more smaller investors move cash into silver, and maybe take, to the extent that they have speculation money in the stock market, they're going to pull that out and buy silver. And I think that, I mean, to the extent that gold is going to move higher, and I think, again, I don't want to put a price target or a time frame on this, but I think if we were to have the same conversation a year from now, gold will be at least 20% higher, maybe more, probably a lot more. I mean, I've got my own personal views, but I've learned over the years, with the amount of manipulation that goes on in this market, in the precious metals market, that it makes it very hard to forecast, and you're just better off buying and holding. So let's say gold goes up 20% over the next year, I think silver goes up at least 35 to 40%. In other words, it's going to go up twice as much. And I think a lot of that's going to be driven by what eventually will turn into a stampede into chasing silver again. I mean, I remember, back in mid to late 2008, I would buy a box of silver coins from a place like SD Bullion, and then as soon as it came, I would reoffer it out on Craigslist, and I'd pay maybe $2 an ounce over spot, and I'd be able to resell it on Craigslist for $4 an ounce over spot. So I think you're going to start to see, especially as the demand starts to increase at a greater rate than the supply, I think you're going to start to see some pretty big premiums come back into the silver market and the coin market.
Yeah, it'll be darn interesting to watch how that unfolds. And last question for you today. You had a good point about some of the junior mining stocks this morning, and perhaps you could share that again and let folks know what you were thinking there.
Sure. We were just having one of the presenters from EMX Royalties was talking about how the junior mining sector, the explorers, are incredibly cheap, measured relative on a historical basis. They're very cheap right now. And I brought up the point that, I've been involved in this sector, knee deep to chin deep since 2001. And back then they were extraordinarily cheap. If you measure, just say, take a median market cap of the junior exploration mining stocks and measure them relative to the current price of gold and silver, we're the cheapest that we've been since 2001. And in fact, I've seen an analysis that uses the Barron's mining stock index that goes back to like 1951 or something like that. And in fact, the mining stocks relative to the price of gold and silver are the cheapest they've been in, what's that, about 70 years. So, and I can just say that there were stocks around back then that are, similar stocks that were around back then that were trading at the same type of market cap. And yet the price of gold and silver back then, when I started, silver was $4 an ounce and gold was $300 an ounce. So fast forward, silver's at just below $17 an ounce and gold is $14.80 an ounce, roughly. And a lot of these stocks are trading at the same levels. Golden Star GSS, I think it's Golden Star Resources, whatever it is. I used to trade it all the time. I don't trade it anymore. But that one was trading below $1. I mean, it doesn't trade it trades at a slightly higher level, but they're actually producing now. Back then, they were just an exploration stock with a lot of risk. So That's just one example. And I've got some examples that I follow in my mining stock journal where the asset value of the company is greater than the market cap of the stock. So, I mean, it's a classic value investing argument. And at some point, as the incredible stock bubble starts to deflate and blow up, not all that cash is going to, go into mining stocks, but, a huge portion of it will.
Yeah, you know how I feel. I certainly agree. And I think for people who are able to invest with patience, that there certainly are some incredible opportunities out there. Again, this is not legal financial advice. But fortunately, Dave, you do publish the Mining Stock Journal. And perhaps in wrapping up, you can let folks know if they're interested in learning more about these ideas, where they can find you.
Sure. I've got my websites, investmentresearchdynamics.com. And they're on that, at the top of that website, there's links to my Mining Stock Journal, which is a bi-weekly investment newsletter. So it comes out twice a month on Thursday evenings. And then I also have the Short Sellers Journal, which is a weekly that comes out on typically sometime during the day on Sunday. So in fact, one of my stocks that I've been pounding the table on as a short was down over 5% today, Lending Tree.
Yeah.
So it's, I look for ideas that, I think you can make a lot of money on shorting them. And even though the stock market's it seems like it's going up nonstop, there's a lot of stocks that I uncover that have actually been going down.
Yep. Well, they're great journals. I love reading them. I'm figuring out how do you decide when the bubble is going to pop is the tricky one. And maybe we'll dig into that next time. But Dave, it's great seeing you this morning. Great to see you again today. And we will catch up and do this again soon.
Likewise, Chris.